Everybody, today is Wednesday, the 31st of January, and our cautiousness ahead of the Fed paid off well for us because we had a gap lower and continued lower throughout the session. We undercut all the levels of potential support, and a lot of people were saying this is support. Well, obviously it wasn't. We only know support after the fact. We also undercut the anchored volume weighted average price from the low here on this day, and it just seems as though we're in for a little bit more profit taking. The rally came right up to the anchor from the beginning of the week prior to that Fed announcement, and now sellers are in control. It typically takes a couple days for the market to absorb a Federal Reserve meeting announcement, meaning maybe we're going to settle down even in towards that year-to-date anchor in the 20-day moving average here in the daily time frame, start to stabilize, hold above this prior band of resistance, and then perhaps continue higher, or maybe we just need more correction through time. Here's what we do know, that we are in corrective mode. We're below a declining 5-day moving average, and that 5-day moving average will continue to decline at least first thing in the morning, because when we're down in this area and replacing this data, that means we'll be below that. Now, maybe we get a bounce even up and towards this level. I'm only looking at it for now as a bounce below a declining 5-day moving average. That is likely to bring us a lower high. Whether that then turns into a pattern of lower highs and lower lows remains anyone's guess. I'm not here to predict the market. I'm here to say that the present bullish environment that we had been in has now switched, and we have to be a little bit more cautious. As long as we're below that 5-day moving average and the week-to-date volume-weighted average price, and we will provisionally put an anchor on the highs of this move as well. So in the S&P, that's really about 486. If we run up towards that level tomorrow, then that's a potential level where it might start to slow down on a bounce and then roll over. The NASDAQ down 8 points today, so much, still not even quite just about 2%, 1.96%. We can see that post-Fed, we rallied up right to the week-to-date volume-weighted average price and sold off from there. We didn't find any support at all from this anchor. We put those there as a level of interest to say, let's see how it behaves as it gets down there. Let's see how it behaves at this prior level of support. Will it become support again? Or in this case, resistance, which raises our caution a little bit more. We're below the week-to-date volume-weighted average price. Maybe we come down to this purple VWAP and start to bounce a little bit tomorrow. And then on Thursday, late afternoon, and Friday, we come down to the 20-day moving average and year-to-date anchor in this prior peak over here. And we could, of course, start to do things like put an Fibonacci off of there and say, well, we've pulled back 38.2% from the low of this year to where we are right now. That's a level of interest, but there's no evidence that the buyers are gaining control here. And with a declining 5-day moving average, I'm going to be a lot more reluctant to be a buyer of this market. And when we have all these markets below the declining 5-day moving average, it tells me if I see a strong setup in the individual stocks to the long side, I'm going to trade them with less conviction, meaning more share size, and I'm going to be quicker to get rid of them if they start moving against me, because we're not in a bullish environment. I don't care about the labels of bull market and bear market. They mean nothing to me. What means something to me is, where are we overall in the intermediate term time frame, the time frame that I trade on, because that's what's important to me in my account. Investing, trading, it's a selfish endeavor. The definition of a long-term bear market or bull market has nothing to do with me trying to make money each day and each week. So I just try to control risk as best I can. A lot of people thought that this meant the buyers were back in control of the Russell 2000. I was looking for it to pull back, stabilize, and then continue to move higher. I'm not going to buy these breakouts that get extended, and that kept me from buying this. A lot of people, I think, just given the magnitude of the sell-off, 2.5% in the Russell 2000, I think it means a lot of people got trapped yesterday. And those people who are looking for the Russell to take the baton and continue to move higher still have to recognize that this was a massive rally, and it probably needs more time to settle down. A test of the 50-day moving average certainly looks imminent here, and maybe it doesn't happen right away. All your gap closure people are going to say it has to do this, and I agree. So maybe it does this, closes that gap, takes some stops out, and then begins to bounce. And if it bounces, well, then the 5-day moving average will start to look like this. The week-to-date anchor will look like this. And then I would set an anchor here. And this is the running commentary I do each and every day for subscribers. And then I would want to get short over here. Or maybe I would just want to avoid it, but I would look at this as simply a bounce overall. Semiconductors, this group has had just a phenomenal last several years. Beautiful pattern. For Elliott wave people, you could look at this as 1, 2, 3, 4, 5. That's the completion of a major move. So maybe it needs a deeper correction. I don't know. I'm not an Elliott wave expert. Here's what I do want to look at is what's the retracement level? What's a 38.2% retracement of the move from the low of 2024 to the high of 2024? A 50% retracement would bring us right down to the 20-day moving average and the year-to-date anchored volume weighted average price. Something to remember, though, about that 20-day moving average is right now, yesterday it was 178.82. Today it was 179.66. It rallied by 80 cents. Tomorrow it will continue to rally by about 80 cents, even if we're down here, because we're going to replace it with data from these 2 days. We're averaging those out. So the 20-day moving average is rallying sharply here, and it's not always going to be a level where there's buyers magically defending it. What's more important is where are we in relation to the anchor from the high. This is the 2024 high right now, and I'm going to keep an anchor on that, just as I've kept an anchor at the beginning of the year, and I had one off the low. I don't know where that went, but here's an anchor off of the low. So those two levels, off of the low in the beginning of the year, those are going to continue to converge here as we get more data. Anyways, that 50, there's a lot of reasons now to think maybe 180, 81 is going to be a place where there are buyers. And how would that occur? Maybe it comes down like this in the next few days and then begins to stabilize into next week. And later next week, sometime, Thursday, Friday of next week, it might be over here looking for that opportunity. The biotechs, they tried to get moving yesterday. As I pointed out to Alphatrends subscribers, we did not want to buy there. Look at the personality of the market. Rallied up there once, got slammed, rallied up there again, got slammed, rallied up again, got slammed. So here we are back down, a lot of people trapped. It looks like we're back to the possibility of going down to test that 50-day moving average. We're back below the anchor from this low. And now I would look at this and say, if this market rallies up like this and finds supply in this area and the 5-day moving average starts to decline, then it seems likely we'll come down to the 50-day moving average. Whether you want to trade that to the short side or not is up to you. I don't make a suggestion for that. The financial stocks, these guys have had a huge rally. I know a lot of people have been trying to find the top in this, shorting it. This is why I don't short a strong uptrend. A 38.2% retracement brings it all the way down here, and that's pretty far away right now. So I'm not interested in that so much. It doesn't provide much value. We stopped right on the 5-day moving average, and if we start to distribute a little bit, I don't think this market's going to fall apart right away. Maybe it rallies up, makes a lower high, and then we start to see some profit taking. But still, it's overall the buyers are in control with a rising 20, 50, 200-day moving average, year-to-date anchor. Maybe it comes down to 38. That wouldn't be a really big deal, I don't think. Energy names continue to do what they're supposed to do. They found some supply at the 200-day moving average. I mentioned on the weekend video that I have no interest in buying these names because they're in a primary downtrend still. We have a declining 20 and 50-day moving average. We have a declining year-to-date the year-to-date anchor is rising. Last year's anchor is in here. So maybe it's not going to fall apart and this market is starting to heal. Maybe it's going to come down in here like this, rally back up, and start to build some strength. But right now, it's still way too early to get involved in the energy names.